All right,
Thanks,
thanks,
everybody.
team. Dario, you have to send Blake an 8x10 glossy autograph.
Yes.
I wouldn't go that far.
Nice to meet you.
Hi, good to meet you.
Yeah, really, I'm glad I reached out on Twitter. I'm not sure, Dario, if you're going to, was there anything you wanted to share on the screen, or at least we could use our faces and talk to each other with video?
Yeah, I'm happy to put my face up. I don't have anything that I particularly want to share.
Okay, I might have a few things.
Video.
Okay. So nice to meet you. Waiting to see you.
Oh, it says the host has stopped the video. I can't. You have to do it.
Okay. Okay. I'm wondering.
Yeah. And good morning or hello, Dario. I guess it'd be close to afternoon over there. I'm not sure if that is disabled or not, but you know what, Dale? It's good to hear his voice. And Dario, we're just happy to have you here. So you guys have
don't worry.
All
right. Yeah, Blake will get you set up in a much more professional way when you're on Trader Summit, and it's not live. So live is sometimes, like real-time TV. But, let's start with a little bit about your background, Dario. Was it true that you had something to do with central banking in the UK?
Yes. So I started my career at the Treasury, the UK Treasury, in the late 90s. I spent about 5 years there, and then I went to ABN AMRO, the investment bank, where I was doing European economics. And then after the takeover from RBS, and then the nationalization, and then the banking collapse, I went back to the Treasury just for a brief 3-year period, where I was. They basically asked me to do a kind of I look back at the Bank of England, assessing where it had done well, where it had done badly, and then to think about this new financial policy committee, because we were creating a financial policy committee trying to learn the lessons from the financial crisis. And so it was about designing that and putting the tools together. So, I mean, I worked with the Bank of England, but I didn't actually work at the Bank of England.
Okay, so have central bankers learned from the last mistake, or have they compounded it?
Well, I think at the moment they're obsessed with a different mistake, which is the 1970s. Okay. I don't think that you could be a central banker now and not have this voice in the back of your head saying, you're doing it again, you're making the same mistakes they made in the 1970s. And I think, the big kind of hawkish pivot we've had from all of these central banks over the last 3 months is really about that fear. They want to get back to some kind of neutral as quickly as possible. They still expect inflation to come down. So that transitory view of inflation is still very much alive at these central banks. But they're very worried about what happens in, say, 12 months' time if they're still looking at inflation numbers, 4, 5, 6%. And they're worried that they're going to have to do more to deal with that problem.
Well, instead of raising rates, why don't they buy a plot of land and throw some seeds around and try and grow a crop and see how easy it is to bring down inflation?
Exactly.
So they can't print it.
I think the issue here is that they believe their own hype. For the last 30 years, central banks have taken credit for the fact that inflation has been so low. They believed it was about their own credibility. We had these kind of newly independent institutions. They believed that they'd anchored inflation expectations at very low levels. And now they see inflation breaking higher. They see inflation expectations starting to move. They're almost victims of their own hype. They have to at least sound as hawkish as they possibly can. And it is part of that kind of mistaken belief about where inflation comes from. But I do think there's a big difference. So I heard some of the chat before I started talking, and you were talking about different currencies and the pressure that sterling is under, and the euro and the yen, and this kind of reverse currency war that it's
really sterling even more than the euro, because here's euro pound. I think don't you think that this, Dario, could be an early tell for dollar turn, that as bearish people are, on the euro. That's outperforming cable. It's outperforming Swiss. That's a safe haven, Euro Swiss. So
I think we're at. I mean, it sounds weird given where interest rates are, but I think we're almost at maximum hawkishness for those central banks. I think that this is non-Fed central banks. So I think that when you look at inflation and you compare it across countries, we're talking about a very different type of inflation. So the US, you can make the argument that the labor market is overheating, that wages are growing too quickly. And you can see the relief that's happened this afternoon with the slightly weaker wage number in the US. But you can't make any of those arguments about Europe or Japan, because we're basically importing all of our inflation. So you look at, inflation is about to hit 8, 9, 10% across some of these European countries, and yet wages are growing at 1%. So we've got this massive squeeze that's coming through in terms of real incomes. We've got this collapse in real incomes. And I think at the moment, I think there's a bigger risk of a recession in Europe than some kind of secular outbreak of inflation. And I think the dilemma facing these central banks is very, very different. And it just doesn't make sense for the ECB or the Bank of England to be raising interest rates aggressively, trying to chase the Fed higher, when in fact, they have a very different type of economy to the US. And yes, I think they look at the 1970s, and I think they take this kind of false lesson from what happened with the Bundesbank. So there's this idea that the Bundesbank was the only credible central bank after the 1970s, that they kept monetary policy much tighter than everywhere else. Right. And they effectively opted out of the great inflation. There's this phrase that's used in Germany all the time about the Bundesbank opting out.
Deutsche Mark was a hard currency.
Yeah, so it was you had a very strong currency which protected you there. But the trouble is that whenever they've had these same kind of dynamics over the last 30 years, so whenever they've had a big increase in energy prices or a big supply shock, and then they've had this worry about second round effects and wage expectations starting to pick up, whenever the ECB is hiked, because it's been trying to learn that lesson from the Bundesbank, it's always gone spectacularly wrong. So, Jean-Claude Trichet was the best example of this. He had this kind of excessive deference to the Bundesbank. He was obsessed with the Bundesbank. He didn't ever want to do anything that would upset his German-speaking colleagues. And, it led to some very serious policy errors. So you had an oil price shock in 2008. Second round effects, that's what they were worried about. So they hiked interest rates into a global banking crisis. You then had 2010, 2011.
Well, Danny Blanchflower tried to stop them.
Yeah, so then you had the same dynamics again. You had that kind of oil price shock, and you had these wage expectations picking up. And then you had another ECB rate hike, which again turned out to be this disastrous error. And they ended up, with a kind of decade of negative interest rates and zero interest rates. So it isn't clear to me that if you try to follow the Fed higher and try to use your currency to shield you from this, it isn't clear to me that that's going to work. I think that could actually go spectacularly wrong. And you end up just compounding this kind of recessionary force that I think is building in the European economy. I mean, outside the US right now, the world just looks in a pretty nasty state. You've got China, you've got lockdowns, you've got a broken economy in China. The kind of Ponzi financed housing bubble that they had over the last decade is basically come to an end. So you've got.
How come we don't hear about Evergreen anymore, Dario?
Because I think that I think that the initial focus on that kind of Lehman's moment that everyone was talking about, back in the autumn, that was misplaced. It was never about some kind of precipitous collapse in China's banking system. It was more about a growth model for China that had basically broken. And so now they need a new growth model. And all they can really do is try to, export their way back.
Lockdowns are their new growth model?
Well, no, that's the very short term. So in the short term, this is all getting much worse. But I think, the natural end from this is
they are easing.
The RMB has to go down. They're going to have to use the currency to try and get some kind of growth going again once they emerge from this disaster. So you've got this big problem in China, which is very recessionary for the global economy. You've got this enormous problem in Europe, which is that we're just having this enormous squeeze on real incomes, and the economy over the next 2 months is going to be contracting in a pretty nasty way. And in the US, you have this very rapid tightening in financial conditions, which, even though I don't think this is the beginning of a US recession, I think you could get a growth scare in the US that comes from, some of the most cyclical parts of the economy beginning to slow down. So housing, consumer durables, That's effectively what the Fed wants. And
well,
then
I did see a news story, Dario, that consumers here in the U.S. There already is some demand destruction. They're driving only when necessary. They've changed their habits on groceries, and I think there was something else that is a major change for them. So they're pulling in their horns. In other words,
yeah, and
even the best dirty shirt, which is what everyone's saying, the U.S. has is the best lousy economy in the world. It's having impact here. I think
I think
maybe we're already in a recession. How
I
about
think
that?
the difference is that I don't think we're in a recession yet. I think Europe's probably in recession. China's probably in recession. I don't think the US is in recession. I think the US is definitely slowing down. But I think the fundamental difference here is that it's almost US demand for goods, which is giving you the US inflation, but it's also giving you the European inflation. So we're basically paying your prices. We're paying US prices for our stuff. And we're not, there's no excess demand here. There's no overheating in labor markets. We just have this enormous squeeze. This is effectively a cost of living crisis in Europe. And, on UK data, which is the longest series we have, this is the biggest squeeze on households since the 1940s. This is an enormous squeeze.
I heard it was like the second worst period as far as, like you were saying, lifestyle since the 60s, when there was a brain drain and there was a currency crisis back then, wasn't there? In the mid-60s.
It's a very nasty environment for the economy, and so we're in this weird position where the Bank of England is hiking interest rates, talking about inflation risk, and forecasting a recession. I think that just shows you how difficult this is for them, and I don't believe it's really credible for them to just keep being hawkish. I think part of this hawkishness is about this worry about expectations and wanting to do the right thing. But I think that those central banks are facing a fundamentally very different task from what the Fed is placing now. I mean,
can you explain the Great Resignation to me? How we went from supporting the millions of unemployed during the COVID crisis to now having a labor shortage and people leaving their jobs? Are they all trading crypto and they don't have to work anymore?
So this is I think this is the biggest issue for the Fed right now. And you listen to Powell, this week. What did he say? He said, well, we've had a lot of bad luck over the last few years. We've had wars, pandemics, energy shocks, food shocks, lockdowns. And he said, now it's our job to look at what the economy is going to look like coming out of this crisis. So he's very much focused on this imbalance between demand and supply in the US labor market. Now, that imbalance doesn't really exist in Europe. But from a US perspective, you've got two issues. You've got one, which is that demand for labor has recovered very quickly and has gone above where it was before the pandemic. But on the supply side, there's been a net loss of labor supply. People have dropped out of the labor market. There's lots of potential reasons for that. One of them is, as you said, the wealth has gone up, so a lot of people have retired. So there's been a big hit from older workers leaving the labor market. So there's this fundamental imbalance, and you've got Powell hoping to generate this amazingly soft landing, which has never happened before in history. This idea that the Fed is going to hike and eventually that's going to cause labor demand to go down and it's going to rebalance the labor market and wage growth is going to slow, but unemployment is not going to go up. So we're not going to have a recession. I mean, this is almost fanciful.
Yeah.
The only chance they've really got of a soft landing is that inflation is going to have to come down by itself. You still have to believe in the transitory narrative to think that there's any chance of a soft landing. If you think transitory is gone, and this is a secular inflation problem, and if you think inflation is going to settle at levels that are too high for the Fed, which I would say is probably above 4%, if it settles at 2 to 3%, I think they'll be delighted. If it settles at 3 to 4%, I think they will probably just about accept that. If it settles above 4%, history suggests that they'll then just ratchet up interest rates, and that will cause a recession. But in terms of what has caused this, I think some of it is the wealth, some of it is people dropping out of the labor market, some of it is related to COVID and will probably fade quite quickly. But one of the big things is the nature of the support that the US has pumped into its economy. So in particular, because there wasn't the kind
fiscal.
of Well, because there wasn't a social security system, you basically just made everyone unemployed in order to get the fiscal support. So you put everyone into the unemployment insurance scheme. So you created this big separation between workers and employers. And that didn't happen in Europe, even though we used similar levels of fiscal support, particularly in the UK, where the fiscal deterioration is basically the same as the US. We used a furlough system, which meant that you were still attached to your employer. And so to receive the government support, you received it directly from your employer. But there was no separation between workers and jobs. And that seems to have been a big factor in how this is playing out, because suddenly you've got the great resignation in the US. People are moving jobs. They're getting big wage increases from moving jobs. And that's just not happening in Europe. We've gone back to our old employers. And in fact, during the pandemic, the people that received those furloughs actually took a haircut on their wages. So usually these schemes paid out, people 80% of their wages. And so now their wages have gone up just because, the furlough schemes have ended. So it's been a very different type of policy dynamic. And when I think, when we look back on this crisis and we say, who got it right, who got it wrong, I think the nature of the fiscal support, not just the absolute level of fiscal support, but the actual way in which the money was put into the economy, I think that's going to be a big factor in thinking about, what kind of inflation patterns emerged from this.
What do you think about all of this weakness in cable when you look at it long term? Do you think it's overdone? The sell-off in cable?
I think that a big part of this is, well, firstly, you've had these kind of head fakes recently because the Bank of England was hiking early, sounding very aggressive. It sounded like they were going to ratchet up interest rates very quickly. And then over the last few weeks, they've kind of stepped back a little bit and thought, well, can we really deliver on this? And so you've had this kind of softening in the rhetoric from the Bank of England. I think that's giving you these kind of ups and downs that we've had recently. I think that a big part of the story here is basically Brexit, that our trade position has just deteriorated so much after the pandemic and after Brexit. And also that's a problem in our labour market because, you've in the US, they've lost a lot of workers through less immigration. But in the UK, that's been particularly pronounced because, a bunch of EU workers went home during the pandemic. And then they thought, well, we don't want to go back there because they've just voted out of the EU. And so I think, we've got this kind of longer term deterioration in our trade position that is coming from the fact that we've just cut off our biggest export partner. And that's what you're starting to see in some of this data.
Okay. And how does what's happening in Ukraine factor into your thinking?
I think that at the start of this war, we were particularly worried about the financial repercussions of this. So
like Russian defaults?
Not so much Russian default, but the fact that there is a huge amount of financial exposure from European banks to subsidiaries in Ukraine and Russia. And so, you looked at the banking exposures and you saw that Italy had this big vulnerability. France had a big vulnerability. Some of the smaller European countries had this vulnerability. And then you were seeing the tensions in commodity markets, and you were getting these margin calls in oil and energy and all kinds of commodities. Yes. And we know that European banks are a massive part of global trade finance. So I think my immediate concern was about financial contagion from what was happening. And I think the fact that that hasn't happened so far is a source of comfort. The fact that we haven't seen these big, nasty financial spillovers kick in Europe. For a while, some of this data suggested that we were on the brink of a European banking crisis. It was really looking quite dicey. That stuff has calmed down. Now I think we've got the kind of recessionary impact of this. So this is about energy and food prices going up massively. UK heating bills have just doubled. We're getting massively squeezed by this. And so when you're paying double on your energy bill, and your energy bill is already a big part of what you spend money on, then suddenly you've got far less money to spend on anything else. And I think that's what we're seeing in the data now. The next 2 months, we're going to get this big decline in discretionary consumption across Europe because people just don't have the money to spend. But it's adding to the inflationary concerns as well. So you have this kind of stagflationary impulse as well. because some of these inflation numbers are going to hit double digits now. I mean, the Bank of England is now forecasting 10% inflation in the UK.
Okay, and will that be exacerbated if Europe goes ahead and bans imports of oil and less so in natural gas?
Undoubtedly, that's.
Are they going to do it?
It seems to be where it's headed. 2 months ago, the rhetoric on this was very strong. We won't do that. It's just been softening and softening. So I think that's almost inevitable at this point. And then they're going to try and speed this transition to renewables, but obviously that isn't going to happen quickly. So we're going to have this period where we had a taste of this during the autumn and the early part of the winter, when we were relying on kind of intermittent renewable energy, and it was causing this crazy volatility. And obviously, looking back, we now know what was happening. Putin was effectively cutting off the supply of energy and causing these shortages to give us a taste of what was to come, to try and warm European consumers up to the sense of what was about to happen. There's a lot of mystery about it when it was happening. Now I think it's quite clear what was going on. And that situation is only going to get worse. So I think if you're a central banker, I think you're looking at a massive energy price shock on top of an existing inflation problem. And then that's where this fear of the 1970s is coming from, because in the 1970s, you had massive energy price shocks, but you already had an inflation problem. And then I think central bankers are seeing these other kind of eerie similarities with the 1970s. So the second one is that nobody expected the inflation outbreak in the 1970s. Bond markets didn't see it coming. Economists didn't see it coming. Central bankers didn't see it coming. You'd had this very long cycle during the 60s where the Phillips curve basically flattened. And we were able to get lower and lower levels of unemployment without any inflation. And then suddenly all of that changed. Suddenly we had this kind of vertical Phillips curve and this incipient inflation problem.
I think this is the 70s on steroids, Dario. Okay, go ahead.
Yeah. And then you had, famously, central banks were quite slow to respond because at the start they blamed it on transitory forces and, said inflation would come down and it was just food and energy, and then it turned out not to be. And so I think
we didn't have a food shock back then in the 70s. That's a differentiation. It's the first time we've had both an energy and a food shock simultaneously.
Yeah, and I think that's what worries the central banks, that they can see these kind of eerie similarities with them. But I would say that this is fundamentally different, because what the 1970s was really about, it was a conflict between workers and labor. It was effectively a power struggle. You'd had a kind of trend slowdown in productivity, and then you had this decade-long fight about who would pay for that. And the countries that had the kind of really serious wage price spiral, so the UK, the US, some of the Euro area countries, they were ones where you had this very militant workforce, and you had, series of industrial disputes, strikes. This went on for a decade. And the country that didn't have any of that was Germany. And it wasn't because the Bundesbank was so credible or because the Bundesbank raised interest rates a bit. It was because you had German unions that were effectively colluding with employers. You had these powerful trade unions, but they were coordinated. So they worked with employers. And so you didn't get that power conflict. And I think, the issue here is that we spent the last 40 years basically dismantling the economy that produced those wage price spirals. And I think it's very hard to see that coming back in that same kind of way that we had in the 70s. So I do think this is very different. And I think if central banks become too obsessed with these ghosts of the 70s, they're going to make some very serious mistakes, particularly in Europe, where the inflation is very different to the US inflation.
Okay, so in the last few minutes, what's the biggest takeaway from Dario Perkins about what type of world and economy we're moving into late spring, summer, and fall?
I think we have an immediate growth scare. And I think this is a global issue. I think all of the main parts of the world are going to be slowing down. I think that will take some of the momentum out of yields. It will stop central banks from being overly aggressive. This is probably our best chance of any kind of a soft landing. We get a soft patch in order to get a soft landing. That, I think, is the kind of most likely environment. I think that there is a fundamental difference between the US and the rest of the world. So I think this is naturally a strong dollar environment. I don't believe that central banks in Europe can be credible in terms of the policy tightening that they're talking about right now, particularly given the immediate recession risk. And I think that you have to worry about what a strong dollar does, because if you're a US policymaker, you're looking at this and you're saying, well, a strong dollar is exactly what we need. But I would say that the textbook view of what the dollar does is completely out of date, because when the dollar goes up, a lot of bad stuff happens in financial markets.
Emerging markets. I think actually the financial markets would welcome a weaker dollar.
Yeah, because what happens when the dollar goes up, what the economics textbooks forget is that everybody invoices in dollars and everybody borrows in dollars. So when the dollar goes up, you get a contraction in world trade, but you also get a contraction in cross-border lending. So you get this drying up of liquidity and financial intermediation. You start to get strains on global value chains because these are financed using dollars. And so net, the dollar going up is very deflationary for the world, and it doesn't rebalance anything. If anything, it compounds that gap between the US and the rest of the world, because it hits the rest of the world a lot harder than it hurts the US.
Okay, that was crystal clear. If you want to follow Dario, follow him on Twitter. Is that correct? At Dario Perkins?
Yeah, that's it. All one word, Dario Perkins.
Okay, and why are you on Twitter? You just like to share your ideas, and do you have a business model, or you're just out there trying to, keep people aware of narratives that aren't really helpful, and trying, basically communicate where we're at so that people can make better decisions?
I think it helps in terms of brand awareness. So I work for a macro consultancy, and it helps to be part of Twitter. But I think to me, it's more about sharing. So, I test ideas on Twitter. When I'm thinking about writing something, I put initial thoughts on Twitter and I get responses to that.
Right.
It's great for sharing information. So, there's lots of interesting charts on there. The latest academic papers go up there, reaction to what central banks are doing. I just find it really useful from a research point of view, beyond, any kind of profile raising that you may get from Twitter. I think it's just a really useful source. And I think that sell-side research, macro research has been, fundamentally changed by Twitter over the last couple of years, and it's been disrupted. And I think that we have to learn how to deal with that going forward.
Okay. What good is anything until it's shared with another?
Exactly.
All right, Dario, really, it's a pleasure meeting you. And why don't we talk again later on this summer, see how things are shaping up, both here in the US and across the pond.
Okay, great. Thanks very much.
All right, everyone. Dario Perkins. I hope everyone has a great weekend. And the rest of the day, you could join the team in 14 minutes for the Morning Edge. We laid it all out on the court for you this week. Hope we're adding value to what you're trying to accomplish in a fairly difficult endeavor if you've been doing it for a while. So have a great weekend, everyone. Don't just count your pips, count your blessings. See you next week. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.